Hey guys, it's Tyler here from Foundation Investing, and today we're talking about the PE ratio. Let's get cracking. So what is it and how do we use it? So I want to start off this presentation with a shout out to Shaveen here. He asked this question originally in our Facebook group. If you're not a member yet, click on this annotation here in the links below. It'll shoot you right over to there. Join. We have a lot of fun. We talk trading, markets, politics, strategy, lots of good stuff in there. Anyway, hey, I was wondering what the significance of the PE ratio is when evaluating a stock. Great question. I've read that it's a measure of how much of the stock's earnings you're purchasing with one share, but going for a high PE ratio is not always reliable. For example, Amazon PE ratio is always high, 408 today. It's a metric that's always on a stock ticker, so just curious how it can be useful. Thanks. Well, Shaveen, really appreciate you asking that question, and I hope you learned something from this presentation. Let's get into it. So what is it? PE is a metric used to help analyze the value of a stock. That's the short and sweet definition. It stands for the price of the stock divided by the earnings per share. So for example, take company XYZ. It's trading for $50 a share and earned $5 per share in the last 12 months. TTM there stands for trailing 12 months. You'll see that on most PE ratios. To get the PE, we take $50 a share and divide it by the earnings of 5, and we get 10. So the PE ratio of XYZ is 10. Investors are willing to pay exactly $10 per $1 of XYZ's earnings. Now, what if a company has no earnings or negative earnings? Well, we don't really calculate a PE for those, and we just write NA. So if a company has negative or zero, don't worry about the PE. It's not used in those situations. Now, a couple of rules of thumb of what PE represents. Lower PE is indicative of value stocks. It's because investors have to pay less money to get $1 of earnings. And higher PE is indicative of growth stocks because investors are paying so much for $1 of earnings that they have to be compensated somehow, and that's usually through future growth. Average for the S&P is around 15, and that means that investors are willing to pay $15 per $1 of earnings. So now that we know what it is, how do we use the damn thing? Because we want to use it to make good decisions on our stock trades. So PE can vary drastically between sectors. Biotech and tech will have much higher PE ratios than utilities and other steady and safe sectors. So it's important that you use PE as a comparison with companies in the same sector. Don't go comparing PEs of tech companies to utility companies. Now here's an example of the application software space. I have Intuit, Adobe, Red Hat, and Paycom here. You can see those PE ratios range from about roughly 63 to 73. And we can use the PE to do a relative valuation analysis here. So Paycom is relatively expensive to Adobe, Red Hat, and Intuit. Even though these are all much higher than the average, we're not looking at that or using the PE ratio in that fashion to tell us all of application software is overvalued. We're using it to tell us which application software company is overvalued compared to the rest. Now here's a group that's below the average, and this is credit servicing, Buffett's wheelhouse. So we got Discover, Western Union, Capital One, and American Express. Now these companies are much lower than average, and they jostle between 9 and 11. So if we can compare credit card companies, we might say, hey, Western Union is the most expensive compared to some of these other ones in here. American Express is at 10, and Discover is at 9. So we can say, hey, per credit servicing companies, Western Union is the most expensive. But again, we're not going to use these and compare them to tech companies and say, oh, since these are so low, these are such a better deal. That's not the case. Only use PE to compare within the same sector. So let's go over a few other downfalls of PE because people get tripped up a lot and think that the PE is an end-all be-all thing when it's really not. So first off, PE does not account for growth at all. So a high PE may not be a bad deal if the company is expected to grow revenues and earnings a lot in the future. So investors might be paying up a lot for a stock and it might skyrocket the PE, but they're expecting huge revenue growth and huge earnings growth in the future for all the money that they're putting up for the stock now. PE can also be manipulated too. So companies can massage their numbers and really manipulate their EPS to make PE ratios look a lot rosier than they may be. So be on the lookout for that. It's not an end-all be-all type of indicator. If you do some more digging down deep in due diligence, you might be able to see if they're massaging their numbers a lot or not, but just be aware of this fact that they can do it. Now, since we're huge macro traders and we love to trade the broad markets, we like to talk about how does PE affect our macro outlook. So here's the S&P 500 PE ratio. You can see here all the way back to 1880. It oscillates between 10 and 20-ish, with a couple big super spikes. But this is actually not what the pros use to evaluate valuation for the S&P 500. They actually use something called the Shiller PE ratio. What the Shiller PE ratio is taking the last 10 years of earnings for the entire market and averaging them and adjusting for inflation, and we get this number. So you can see it's a lot smoother. It puts things into better context. We can see here the Shiller PE for 1929 at the height of that boom before the Great Depression, also on Black Monday. And you can see in the .com as well, the thing was well above 40. And finally on the right, at around 24, we're at the high end of the range in terms of valuation right now. But you can see on average, the thing is around 15. And this is what we use to judge the overall expensiveness or cheapness of the S&P 500. So just to recap here, why the PE is useful. It's useful for broad market valuation perspectives, like I just talked about, and valuation comparison between similar companies. But what it's not useful for is valuing companies that are expected to have a lot of growth and no earnings right now, or valuing companies across sectors, like I talked about. So remember, don't go and take a tech PE and compare it to a utility PE. That's not how it works. Compare within the same sector. And finally, remember that PE ratio is not a holy grail. It's not going to tell you what to buy and when to buy it. At the end of the day, it's just one of the many ratios and metrics that investors use to analyze a company. So that's it for the PE ratio today. I hope you enjoyed the presentation and learned a lot. Please follow us if you like this on social media. Also subscribe to the channel. I put all the links for our Twitter, Facebook, and StockTwits below in the description. Our website's foundationinvesting.com. That's in the description as well. Thanks for tuning in. I hope you learned something, and I'll see you next time.